This is the headline that's garnering all the attention today.
All the evidence shows there's a investment boom going on.
Markets are looking for clues about the health of the job market.
Artificial intelligence absolutely has already been a disrupting force.
People are right to question how much longer this bull market can run.
With stocks rising, fueled by big tech and easing trade tensions.
This week, the Fed voted to lower interest rates another quarter of a point.
Take a look at futures. Now a little bit of a mixed bag. We've actually seen the Dow tick lower.
Oh boy, here we go again.
It's time to tune out the noise and tune into great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that will move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman. That's Lucian Gindorf, and this is A Steward's View. It's great to be back with you. This week, as usual, you can check out the Economic and Market Roundup at astewardsview.com/blog. Again, astewardsview.com/blog. You can check out all that happened last week and a little bit of what's going on this week in terms of the economics and the markets that we're surrounded by. Okay, the noise, if you will, but a summary of the noise. So go take a look at that. I encourage you. This week on ASV, this is an ASV Plus episode. I'm really excited about this, Lucian. We're going to continue the series called Peace About Portfolios, and we'll focus on advanced retirement income planning. Okay, and when I say advanced, it's not that these concepts are going to be so hard to get. It's that we're going to take a series of different ideas, different approaches to investment, approaches to planning, and we're going to pull them together into one single illustration of how everything can come together for the benefit of you, the listener. Okay, and I'm going to focus on a case study that's a very fresh conversation with a dear friend and I suppose prospective client of our firm at Fideer Advisors. Fideer is the sponsor for this program. Before we get there, let me just mention, we will combine, I mentioned asset optimization a lot on this program. We are going to get into those concepts briefly, along with total return investment points. And so we'll get to a consistent method of taking withdrawals from your portfolio. And we'll just work towards keeping the portfolio in its place. Okay. And where is that? In support of your plans. Okay. So our goal, what we're here for, is to elevate and enhance your decisions with or without professional advisors. The major idea associated with A Steward's View is that life is extremely short, and we're stewards. We're stewards of our financial resources for just a short time. Our decisions then can flow from that perspective. With that wisdom in mind, let's take a look at our core content for today. So we've gone a little bit into case studies in the past, and last Friday, I had a phone call with a good friend, and he is working on part of his retirement plan. And in that phone call, he shared with me that he has, I'm going to go to the numbers here, a desire in 2 years' time to land, and I'm going to round numbers on purpose, but he's going to be in 2 years' time right at $1 million asset base that he's going to use to fund part of his retirement income plan. Okay, and so the rest has to do with Social Security, and I believe there was a pension in there. But as to the $1 million, he wanted to take roughly half of it and buy in now or soon to an annuity. Okay, I can explain the kind of annuity. We talked about annuities in detail late last year in 2025 on this program in our Products and Prices series. I encourage you to check that out. But half into an annuity and the other half in 401k. So that's all fine. But I want to say something very clearly here. And I want to say this to our advisory, the advisory community, the financial advisory community. There's nothing wrong with putting $1 million to work into a retirement income plan. But if your client is coming away with a conversation about vehicles, instead of anything else, like that's the first thing and maybe the last thing, then we do need to level this up. Okay. And so I'm going to try to do that in this episode in a way that is helpful to both the investor and the advisory pro. Okay. So let's go into it. I sent him an example. I said, this is a situation that's very common. It's not a right, wrong, totally, but the question of is it optimal, right? Both in terms of the portfolio and the income out. Okay. So did we optimize assets? And then did we optimize the income or the financial planning points associated? I will say that I don't have yet a copy of the income annuity plan, but it was a lifelong withdrawal rate that was based on he and his spouse's lifetimes from just what is his individually titled assets, IRA or not. I believe it is an IRA, if I remember correctly. So let's assume this is all, qualified or retirement income, retirement capital, meaning it's pre-tax money, regardless, going in, this $1 million going in, and half of it's going to go to an annuity and half of it's going to go to the 401k in that proposal that I haven't seen yet. So I'm getting this secondhand. Okay, there's my disclosure. I want to see those withdrawal rates. I haven't seen them yet. When I get them, I'll dumb them down. I'll take names off and I'll post those on a Steward's View, assuming I get them in a future blog post. Okay, for now, I want you to know what I said. Okay, so before I sound like I'm getting into vehicles also, let me just say that this entire conversation hinges on, do you have a strategy and what is it? Okay, if your goal is to take retirement income in 2 years' time and take it as efficiently as possible and consistently as possible, there are lots of ways to do that. Which is why I asked the question, why are we talking about vehicles like the whole way through? So the first question I like to ask is, well, what withdrawal rate might we look for? Okay, and that question depends on another question that comes ahead of it, which is, do you want to utilize your retirement capital during retirement? Do you want to draw it down gradually? Or do you want it to last more in terms of the current asset base and maybe plus inflation? That's a super important question. Yet we have to answer that up front. So whether they're, whatever vehicles they end up in, we got to know, are we going to utilize the capital, draw it down over a period of time, or are we going to keep it preserved? Okay, because those are two very different withdrawal rates. In the one case, and I'm going to use a range of numbers that can work or have worked in the past. Okay, because these are debatable points. Like as soon as you get into, the how on something, there's going to be a debate. But to draw down capital, if you take more than 5%, 6-7%, let's say, even 8%, you're likely to draw down your capital. And will you run out of money? Not historically speaking, in a well-balanced portfolio that is generating consistent returns over time on an average basis with a minimal amount of risk. Okay. And, I can fill in those blanks, but that would work. Now, if you said, well, I want to preserve my capital, the whole million, the whole way through, I'm probably better off with a 3 or 4 or 5% withdrawal rate. Okay. If I really want to keep up with inflation and preserve my capital, so not just have a nominal amount of capital that I started with, years down the road, but I've actually been able to either increase my income or increase my capital or both slightly to keep up with inflation. Now I need, more like a 3 or 4% withdrawal rate. Okay. So that's about as dorky as I want to get on withdrawal rates. But the point is that this all hinges on, are we going to draw down capital or not? Okay. It sounded from this phone call last Friday, July 31st, like it was sort of a resignation that he had, that he was just going to have to do this capital drawdown, which has me scratching my head, because that to me it's a decision point. If you have $1 million, are you going to draw down capital, or are you going to preserve it for the years ahead? So let's figure that out if you're the investor and perhaps the advisor involved. as a primary consideration, a number one planning point. Okay, then, and we're still not on vehicles yet, then we can start to say, okay, well, we know who the investor is, and I'm assuming that the risk profile has been taken. We have some method of allocating money that is appropriate for that risk profile, right? And so there's some, diversification going on, okay, and some method of oversight for that money. Well, who's doing the day-to-day management is critical in that, right? What is the advisor's role? What is the portfolio? Who are the portfolio managers involved, right? Are they in-house? Are they somewhere else, right? If we're delegating that like I do, because I can't manage 15 areas of the global marketplace by myself every day, then okay, fine. Let's just understand that, and then let's also know what it costs, right? So we have a way of understanding, did we get value for what we paid? So those are the considerations. But that first question of, do we draw it down or do we preserve it in years ahead is super important. Okay, that gives us a clue about the withdrawal rate. Okay, and then we can start to, back into the investment strategy and finally land on vehicles, right? So if I'm on that phone call with anybody, and this happens routinely, and it goes like this, well, I bought this product. Okay, why did you buy the product? Well, I don't know, but here are the features. Okay, well, I haven't answered any question in that I just asked, right? And I don't have a process for funding a strategy based on my goal. So I'm trying to help investors and advisors stay on the goal itself and the strategy in support of it, as to, in this case, the withdrawal rate, and then, yes, the underlying holdings, okay? Not even the vehicle. I mean, the holdings in terms of who's managing and what are they, right? That's what I mean by holdings. Okay. So with that's my context for today. With that, I sent out to him a summary, because he said, I need a higher percentage withdrawal rate in the first 2 years. Okay. And this was kind of a quick and dirty thing for me, but I ran it out as far as I could. It was a 7-year higher withdrawal rate, and then I ran a lower one. There was a lot of tinkering I would have had to do to just do the 2 years higher and then the lower withdrawal rate after 2 years, which is actually what he's doing. And if he becomes more serious about being on board as a client at Fiduciary Advisors, then I will do that for him. But the way this went, I just ran kind of, okay, here's a higher withdrawal rate, and his need was $78,000 a year after taxes on $1 million. Okay, well, based on his tax rate, the estimated gross withdrawal from pre-tax money, annuity or not, pre-tax money, is $92,000, $92,200 a year. Okay, from $1 million. Well, we can do that math, and that's about a 9% withdrawal rate, isn't it? What we just said before is, hey, we're likely to draw down capital, and he knew that. So great. So that's a good conversation that's been had. But he was just going to do it the first 2 years. Okay. Again, I ran out the 9% longer term, no problem. And then sent a separate example of, well, how does it look if you just took out like more of a healthier withdrawal rate? More like, hey, I'm going to preserve the capital then long term. And that was just I cut it in half. It was a 4.5% withdrawal rate then, as to the second example. So these are examples, but they're examples that are based in real life. They're based on, using actual asset managers that my firm uses. They're based on the actual fees of the underlying asset managers I just mentioned, and the fee that my firm charges as well, which varies but hovers around 1% on assets. Okay. And so the way this went, I'm going to go right to the first example. And I'll post this out at astewardsview.com tonight, along with our blog posts and other materials. We took $1 million, and this is, there aren't guarantees in this. This is backward looking. If you need an annuity, let me say this real quick. If you need an annuity because you need guarantees and you're willing to pay, an extra fee, another level of fees, let's say for that, in addition to whatever commission is being paid, and please ask what that is. Ask how much the commission is. Ask. Find out. Just know what you're paying. That's all. Don't make it good or bad. Just know what it is. Then if you're willing, if you have to have a guarantee, then I think a guaranteed withdrawal benefit from a deferred annuity, like was being described to me secondhand here, is a fine idea. Okay, but if you don't need a guarantee, if you can say, hey, I know who I am as an investor, I know what my capital looks like, and I know what I can and can't stomach, and I trust that the right investment plan is going to support me in that, and I can withdraw from my own capital, then I would argue you don't need a guarantee from anybody. You just need to look at 100 years of market history and make some realistic, form some realistic expectations about the future. So, large company stocks, the last century, 10% a year in the U.S. Small companies, historically, the last century, U.S., 12% a year. Bonds, 5% a year. Inflation, 3% a year. Foreign stocks, more like 8%. Okay? So where are you in terms of your mix and your tolerance and your details? That's you and your advisor. But the point is that 100 years of history didn't depend on Donald Trump being in office. Didn't depend on Warsh running the Fed. It didn't depend on any geopolitical event. That's just how our financial markets have operated for a long time. So I want to, leave it there, but understand that we have a lot of history, good history that does repeat itself in terms of market patterns, market cycles, okay? Economic patterns, economic cycles, on a broad scale. So just know who you are with this. If you don't absolutely require a guarantee to sleep at night, you can take an example like this and use it and be successful with it, then please do that. Okay, so the cost on this was 1.25% in an advisory fee. That's disclosed, it's imputed, if you will. There's a gross return and a net return after fees. And all the time, the underlying managers are charging their fee as a soft cost, an operating expense, if you will, or a expense ratio is the formal term. And these are institutional grade shares, by the way, with mutual funds and ETFs. Okay. There are 24 holdings. 2 of the holdings aren't managed. That's cash and an ETF position in gold. The other 22 are actively managed all over the world and relatively lowly correlated. There is a correlation matrix in this as well, if you listen to a piece about portfolios last week. Okay. So I digress on purpose. Here's how it went. We took $1 million. We invested that $1 million in a moderately aggressive way, which is to say we have an 80% growth focus and a 20% conservative or preservation focus in the overall mix of assets, right? Regardless of who's managing, regardless of what vehicles they are. We're taking that $1 million and we're withdrawing 9.2% every year. And that, again, is going to deplete capital usually much faster than lower withdrawal rates. And we took that 9.2% out. This was 1, 2, 3, 4, 5, 6, 7, 8 years of time. And let me get to the total here. Totaled $737,600 in withdrawals from the $1 million. The whole time we did total return investing, which means, who's the 2025 listener to ASV that's still with us? That means we reinvested every return type in every holding the whole time. Okay, so what are we doing? We're withdrawing from principal here, aren't we? We're not drawing off the dividends that change. We're not forcing people into dividend portfolios that are highly concentrated stock portfolios that are good for a fraction of this country, fraction of the world. We're diversifying out. We're hiring out management teams that are, excellent risk managers. Okay. And there's an investment process also described last week. And the week before that, in fact, a few weeks before that, when we did ASV Plus the last time and talked about portfolio optimization, right? Do the optimal thing. So that's all going on here. That whole investment process has been applied. We took the $92,200 per year out. That's the gross withdrawal to net this investor $78,000 per year. Again, the total out over 8 years was $737,600. So fees are all disclosed. The net return, by the way, I didn't mention, average during the period 10.63 per year. Okay. And that's with, let's see, we have 2018 in there. So we had what I'd call an almost bear market in 2018. It was a a little over 1/4 of that year was really tough. 2022, we had a pretty real bear market. Okay, those years are also part of this analysis. So including those times, 10.63 was the net after all fees average return to the investor, no matter how much they took out. But actually, in part because of how much they took out. Let me say it that way. Because if we didn't take any capital out, we've got all of our capital working, and we can probably get out a little better return. In fact, that plays out as this example unfolds. But I digress again. 10.63, given the withdrawal, including the withdrawal rate, was the average net after fee return for this investor. And so, Lucian, can you guess, or I can't ask anybody else. So can you guess how much capital this investor landed at after 8 years? So they started with $1 million. They generated 10.63% that they kept on the $1 million. They took out about 9.2% per year. Okay. How much capital did they land with? Take a guess.
I'm sorry, but I'm not good at mental math.
Okay. So you take $1 million, you take out 9.2. The expectation would be something under $1 million, right? Okay. Fair. So that's math we can all agree on. That was my expectation, by the way. And we landed, after the 8 years, in this example, at $1.05 million. $1,052,230 left after withdrawing 9.2% from the portfolio. Now, there's a number of things going on here to do with asset optimization. I will add that this is rebalanced quarterly, which means that we're looking at how the managers are doing every quarter. We're adjusting things as we go, right? And by the way, there's 100% access to capital in terms of the holdings here, the who's managing and where it's held. This is, my firm holds assets at Schwab as the custodian and operating agent. But 1.05 million was the landing number from $1 million after 8 years of withdrawals at over 9% a year. Wow. Is that guaranteed for the future, Lucian? No, it's not. Thank you. I thought we'd be there together. Thank you. So now, okay, I've saved on the fees associated and the underlying commissions associated with the annuity. That's also, it's kind of a fourth level of fees, right? With the annuity, I've got the underlying asset manager cost, just like here. I've got a commission instead of an advisory fee. Okay, so let's say a commission in lieu of a fee. Those two things we can kind of compare here. But then I have this withdrawal rider, this thing called the withdrawal benefit rider, usually. And that has a fee. Okay, so I saved at least one layer of fees here. I won't put a number on that because I don't have that example or that part of this example in front of me or yet available. But when I do, I'll post it. Okay, so that's the higher withdrawal rate. Now, I'm more realistic for the planners who are listening and the other pros. I realize that 9% withdrawal rate is a very high withdrawal rate. But again, we were trying to just meet a 2-year standard that he had for that level of withdrawals and then dial back to a healthier withdrawal rate. And when I say healthy, I mean healthy in terms of preserving capital, right, in the long run. Not just making it so, I caught up to my $1 million again, coming up for air and then going back down with high withdrawals. No, keeping up with inflation, maybe even growing a little bit. Okay, so I cut that all in half as to the withdrawal rate, and I took the $1 million and I went through 8 years of withdrawals at half as much out, and that was, I'll round here, $48,000 out per year. The return ticked up a little bit because we'd left more capital in the accounts, right? Gosh, we haven't talked about vehicles yet here, have we, Lucian? I mean, I keep picking on annuities a little bit, I realize, but It's funny that I've gone all the way through this and I still haven't gone into who's managing and what the holdings are. Okay. That's I can't say loudly enough. That's where we need to keep this conversation, because it's important to know that that's all well done. That's why we optimize assets. And we'll talk about how to measure that here in a minute. But check this out. We kept capital working. We took less out and we landed at 11% per year, a little bit higher, but 0.4% higher than the previous example where we took more capital out every year, twice as much. We had the same two bear markets, the same underlying management teams and holdings, the same time period, the same $1 million in, and we landed at, okay, I wish we had a drum roll, 1.677,751,000. Okay, great. Now we're having an estate planning conversation, because what happens when we do that, if we could do that, right? And the historical chart suggests that we can do that for a long period of time, for 20, 30 years. If he's going to be 65 years old and he's going to live to 90, how about if we do this, 20 plus years? What does that million turn into even after inflation? What is the legacy attached to that estate? Who's supposed to benefit? So there's a lot. There's a good argument here for varying the withdrawal rate as needed, understanding how the return is affected, but more than that, the capital base will behave, right? Historically speaking, how it could behave there. And then making good decisions, right? At the lowest possible cost with the highest possible disclosure as to what those costs are. Okay. So those were the things that I sent out to him. And I want to come back to kind of what happened here. So the very first thing that he and I believe his spouse, who's, they kind of have like a siloed decision-making program that they do where he's doing his and she's doing hers. That's just fine. But as long as each of them is aggregating, which is pulling together all accounts into a single investment plan, and we do this every day at my firm. This is one of the only things I pitch shamelessly. In fact, I pitched it on purpose. I always make a point, I'm not going to sell anything on this program, but I want good decision-making to happen because of it. So my firm offers this. It's a free service. You don't have to sign up for a contract or services of any kind. You can just use it. Go to fideradvice.com and look at the homepage, or go /Fusion, even click Fusion at the top and request a login. Okay. So we're aggregating here, right? We're not talking about vehicles. We're not talking about investment process. We're just pulling all the data points in every single day from any custodian. We're keeping those old logins, but we're connecting them to a greater login or a universal login. And we're looking at that every day. So then we're deciding, once we've aggregated, where in the world to invest. Okay. So I got thinking earlier about what optimization is. And in my view, it's where in the world are we going to invest? Who in the world are we going to invest with? And how in the world is it going to work? Okay. Where, who, and how. So the where part, that's the correlation, or in finance, the covariance between holdings that I care about greatly. Okay. And that's in the correlation matrix that's presented tonight in these examples I'm posting from this case study last Friday. Who in the world, that's who gets hired, or maybe the in-house people that are running money. Okay. And then their historical 5-year Sharpe ratio and this is the world according to Aaron as it relates to investing a la asset optimization. Okay. Have we lowered standard deviation? Yes or no? And has that affected the 5-year Sharpe ratio? Yes or no? So if we have a 5-year Sharpe ratio that's better because of lower deviation, then I'm interested. Once I know where to invest, or where I'm going to invest based on what areas of the global marketplace are working well together. Okay. And by well, I mean, offsetting cylinders in the engine. That's the analogy. So we go find that 5-year Sharpe ratio among asset managers in those areas of the world. And we look for the better Sharpe ratio from a lower standard deviation. Okay. And then We're going to do rebalancing routinely. And that might be, in my case right now, it's quarterly. That's the way the markets have been. In the past, it's been closer to semi-annual. That's a conversation. But routine rebalancing and then measuring the value of advice. Okay, we're going to do more episodes on that, Lucian. I'm just warning you. I know this is exciting. Try not to fall asleep. Measuring the value of advice, MVA, mean variance analysis would be the term for the portfolio manager. Measuring the value of advice is the phrase the MVA moniker stands for the investor. And that calculator is also free, no cookies, no accepting or rejecting even. Go to fidereadvice.com, FIDERE advice.com. Go to the footer of that website and use that calculator. I think we renamed it recently to advice measurement calculator, so it's more obvious as to what it is. But you just need some basic things from your reports. If you need help, ask, reach out, send us a message through that website, and we're glad to help you. Otherwise, just use it and be successful with it. Invite your advisors too. So this is the most, what I haven't done here is I haven't presented a less than optimal portfolio or a non-optimized portfolio, which exists a lot. So next week, we're going to look at that as well. We'll kind of have a follow-up to this ASV Plus. Maybe we'll have a second ASV Plus, and we'll look at this last installment of Piece About Portfolios that way and say, okay, well, what if this person didn't optimize? What if they didn't do the full process that I've laid out the last few weeks here? And they just took a basic asset allocation from their advisor and they went down the road and shot for 8% as a moderate investor or 10% as an equity investor and, everything in between. Okay. Let's look at that. I don't know is what I'm saying. So I do want to see that. Right now we're giving the optimal thing as it relates to how we've defined optimization. And then we've applied that to this case study and we've looked at withdrawal rates that are both reasonable and elevated in the opposite order, elevated and reasonable. Okay. Or let's say drawing down capital and preserving capital. Okay. One more aggressive than the other. So that's where we've been today. We will do the follow-up on, okay, what if we just did a basic asset allocation, get the pie chart from, a website even, don't optimize anything, take the same withdrawal rates. That's interesting to me, and I bet others that are listening. So let's come back to that next week. Other than that, I want to drive home a point here that I've been making more recently, and that is that your advisory relationship, you are not, as an investor, you are not obligated to your advisory relationship. I want to support advisory relationships. I want them to be thriving, good, productive partnerships that have you, the investor, making the most informed decisions possible with the most disclosure given to you possible. That includes, though, that you know what it costs and what you paid for what you got. And if you don't know those things, I encourage you to find out. Use the calculator I just mentioned. And then think back. Think back to where did this relationship come from? Where are these relationships? Was it a friend of a friend? Was it somebody I met that I just liked, was hanging out at the golf club and thought they were a pretty good person? Maybe the Thanksgiving table. I don't know. Know what their credentialing is, know what their experience is, know something about their track record. We just started publishing, or not publishing, but tracking, making available composites internally at our firm, and we're going to share those externally starting our firm. Fidere Advisors is tracking its composites. Okay. And I haven't done that for 25 years and I regret it. And so we're going to start to publish those in 2027 and forward based on how things are going in at least 4 of our 5 models. So if there's a track record available that is public, how does that look? Who are the people involved? Who are the decision makers? What are the levels? Is it optimal? Is it not? Okay, these are all things that you need to think about. And I promise I'm close. I promised for a long time, but I'm closer than ever there to having the Life Cycle of Wealth book fully available again. And I aim to do that by Labor Day weekend. So I look forward to that. That'll also be out at the media site, astewardsview.com. It shows is out of stock right now because it is. but this final edition has just a few hours of edits remaining, and we'll make that a point to, highlight and help hopefully enhance advisory relationships, how they function, what it looks like, and kind of what to expect when you're in it. Okay, but there was a chapter along these lines posted from that book last week, so I encourage you to take a look at that in the meantime. So those are my thoughts. I don't have a lot else for today, Lucian, unless you do. Okay, well, this has been great. It's just been a joy. We've covered a lot of ground. I hope this session has been a blessing to you and others you decide to share it with. If you have questions or you want to discuss this or other parts of A Steward's View, do not hesitate. Just ask. Email us, team@astewardsview.com. That's team@astewardsview.com. And you can also find our social media pages now, thanks to Lucian, at astewardsview.com, the website. So yeah, it's been a joy from all of us here at ASV. We look forward to what's ahead. Next week, we'll wrap up the series, this one we're in now. It'll be another ASV Plus for you, and we'll look at a non-optimized portfolio and withdrawals and how that went from the same investor's risk profile and just kind of a default pie chart, if you will, as to the underlying holdings. Okay. And notice I didn't even talk about holdings today. Isn't that something? Wow, this is good. This is like ASV Plus, the easy version. Okay, good. So they will be on the report. I promise that. So you can, for those of you that want to know who is managing in this example, you'll have those tonight. But yeah, next week we'll finish up piece about portfolios and the key points associated as to your decisions. Until then, let's do Connect Online. And thanks for joining. Please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.